I'm here to discuss an important topic which has come up a lot on among our customers and feed, and that's what's the difference between a credit card and a debit card. So we don't have this now, right? And it's been around since the 40s, believe it or not. Don't I'm gonna hide this. So you can have this, which is basically a card, and this is a credit card, Visa credit card, and this is a Mastercard. Okay. And I want to talk about the difference between that and this. This is a ring, which is also a card. So this, it's the same as that, it's the same as that, the same as that. Also your phone, I don't have my phone here, but my phone is recorded and it's exactly the same as this. So we have ways of paying for things now. You can pay with your card, debit or credit card, or you can pay with your MasterCard, which is a ring. You tap to pay, similar to paying with that. Or you can pay with your phone these days, or your watch, or bracelet. So we are Orukka. So Orukka, we actually create rings. We create our fintech, payment rings. We also pay. We create fitness rings as well for runners, sleeping, watching your glucose level, checking your activity levels throughout the course of the day. You can see that on one app. You can also see the payments. We're more fintech, so we see a lot of these payments. So today, I think it's important to draw the difference between them, and we'll find out the key players in this market, who's there alongside us, and what they do, and how they make their money. I think that's key. I say that because we see a lot of people saying, my bank is free. No, your bank is not free. You should know this already. If you don't know it, then look back and question what you're doing. If anything is free, then you're the product. That means your time, your effort, or something is going, or your life, something is going. No one gives anything for free, especially a bank. If a bank comes here and goes, it's free, then it's not. Social media is not free. Facebook is not free, right? We all know that now. But you can go to Facebook and put in your name, date of birth, who you voted for, your 100 friends, and track everything. It's not free. Yeah, you're paying for it with your data. You're paying for it with your actions. You're paying for it with being tracked on where things go. You're paying for it with advertisers as well, because advertisers will do anything to know where you're going, and that's your payment. And that's how they pay for the platform as well that you're using. So if that's a contract that you want to get into, then know that that's what you're getting into, and know that it's not free. And the same thing applies to banking. So for us, right, in banks, people go and you get a card from their bank and go, it's a bank card is free. No, it's not, because there are ways cards and banks make money, and I'm explaining that here. So in general, I think I'll start with the simple fintech, and this might be too long, so check if this goes over 10 minutes. I need to get back to work. I'll do another recording where we go through, the difference between Visa and MasterCard. Because Visa and MasterCard are not banks. A lot of customers think they're not. ID, you know, PayPal, PayGo, all those are not banks as well, but they're different type. With your bank on the street is a bank. Fintech is not a bank. So Monzo, Revolut, and all these new bank, N26, all the fintech banks started off as fintech. They are not fintechs. They are not banks. And in some countries, they remain as fintech. Some countries, they're banks. So it's good to know the difference between that. And I'll try and explain that, explain how they make their money. And then we'll talk about the key players when it comes to payments, because that's where you understand where money goes and how they need you to make payments. Let's start from the top, right? So a bank, as you know, if you don't know, I'll tell you now, a bank takes money, lends money. That's the simplest form. So previously you'd have, till now, you still have people who want to borrow money from each other. To do that, there's a middleman. That's what banks used to be. So banks will go and take your money from the lenders, put it together, and since it's not being used, it's borrowed out. And that's it. Now, what happens then is obviously you need to then create, payments off the back of it. You need to do products. You need to sell more products to banks, and that's where we have, bonds. Because bonds is borrowing effectively. The government borrows, and it becomes a bond, which is effectively treasury, ETF, and all those bonds. No matter how complex it is, it's a borrowing. That's all it is. Question is when you get paid. It could be paid in a year, it could be paid overnight, which is an overnight rate. It could be paid in 1 year, and the longer it is, the higher the interest rate on. In fact, the US have a 30-year bond, which is called treasuries. Those treasuries will be 30 years. And the indication of what those interest rates are is what effectively you try and amount to a country's health. So the higher the rates that the government takes to borrow, the higher the credit history and the credit rating of that government. So you see somewhere like the US who is trusted, so they would have lower interest rate compared to my country, from Nigeria, this my parents and myself originally. Our interest rate is high, same thing with any African country, seen as high because there's a likelihood Brazil, Argentina, some countries have defaulted. So that probability is what people look at and decide when to borrow. And not again, we can talk about governments and how they make their money, but it's not like they rely on that money, but they raise it and that's how they print money. And but me and you, we can't, right? Can't go to the bond market and raise money or create a bond that pay an interest rate. So what we do is we go to banks and banks then give out a loan based on what they think about you. And that's where loans come from. I say all that to explain the difference now between a debit card, credit card, loans, mortgages, and things like that, car loans, which is a secure form of loan. Banks make money, one, by charging you a fee. So if a bank comes to you and goes, well, your opening fee is $6 or €6 or pounds, and then that's a fee that they make. They also make money through monthly fees. So they charge a monthly fee or monthly expenditure. That is a fee that they charge. Again, that's simple, that's black and white. You can see that. But sometimes they might not charge you. So they look at you, they look at your profile, look at where you walk. If you walk in New York, okay, there's a potential there. And when you put in there, they look at your date of birth. And I had a series on crypto and why banks don't like crypto. It's for this. So they look at all your profile, they like that, and they decide to go with you. When they do that, they can decide not to charge any fees. That's when we think you have a free bank. And what happens is because of the profile, they know most likely you're going to apply for a credit card. It's history. They know that. So what happens then? They give you a credit card. Credit card, there might be a fee attached to it or payment or a stamp duty, things like that. You pay for those. They can waive that. Okay. When they waive that, that's because they look at the historical likelihood of you missing your payment. And it's not a bad thing, but historically we know, and I worked in banks for several years, right? A good bank would have a 15% late fee or default or, a non-performing loan. So what that means is you've defaulted or you're late by a week, late by a month or 2 months. We're humans, that happens. Banks know that. So what happens is they charge you a fee on that, but that's good because if you're high enough, you're rich enough, you will pay those fees. And that's what they've had once, and that's how they make their money from fees that they charge you on a product, as simple as a card. Maybe they charge you a single card that you thought was free. It turns out after a year, you defaulted on 1 month's payment just over Christmas. Not a problem. Pay for it. That's how you make your money. Car loan. So that we're talking about cards now. So the core cards, and maybe they come to you and maybe you go ahead and you ask for a loan for your house or to build your house. They charge you 9% because of how do you think your risk profile is. 9% is good for a non-secured loan. That means there's nothing behind it. Just give you the cash. You could run away. Stop paying. Right? They look at the bank history, look at your profile, and they give you those fees or those bank loans. That loan and those credit cards are what's called secured loans. Then there could be secure loans. So secure loans would be like a mortgage, a car. Those loans are borrowed against the assets. So it's secured because for some reason you don't pay to take the car back. You have no car. That car is not yours. Same thing with the house. And I have an episode on the houses. If you actually own a house or what, if it's a good idea to own a 30-year debt, because that's what it is. So they give you a debt for 30 years and they charge you, 2%, 2.5 or 3%, which is okay. But if you look at the cost of it, on an average mortgage of 750 at a 2% mortgage, that's 200,000 over the course of 10 years. So they'll make 200,000 and they know you're going to have that house. So that's a good deal on the bank, but they'll give you free banking quote for. And you don't have to stay with the same bank, by the way. You're going to go anywhere, but they know that if you're with them, you're most likely going to get a mortgage with them, you'll get a credit card with them, get a loan with them. And that's how they make money. So your bank is not free. And if you learn nothing, you can switch off right now. If you learn that, that's enough. Your bank is not free. They get money from products that they sell to you. And those products might be more expensive, might be cheaper. I would advise you to shop around. I advise you to shop, again, for your savings account, your expense account. So nowadays you have expense cards, you have expense rings. So use those instead of using the same bank because that's how they make it money. They might charge a little bit more expensive on one side and cheaper on the other side. You have to shop around and think about yourself then. And so that's in terms of banking and how banks make their money. Okay, so typically a bank, what differentiates a bank is they're licensed to borrow money. And because of the back and forth on keeping money, taking money here and giving money there, they're licensed to hold money. So that means then they have a license within a specific country or government or regulator to hold money. That's why you might see Revolut has a bank in the UK, but they don't have a bank in Switzerland. They don't have a bank in the US because they don't have a banking license there. So when that happens, there's an entry level, and those are fintechs. So a fintech then is financial tech firm, which they don't have a banking license. They can't hold your money, but what they can do is they can give you a service. For us, give you a service to say, hey, you have a ring, which is a mixture between the wearable and the payment functionality. And then behind that, you have banks that hold the money, you have banks that actually take the fees and do anything they want to do. We just sell this, and that's how we earn money effectively. And fintechs are the same. Fintechs and turn around, they can hold up to X amount that the country allows them to. But in general, all they do is they can't do much other than open an account for you, which is more convenient on your phone, or now you make payments in a more convenient way. I think Amex also do a bracelet. So you can also, you buy from Amex. If you, I think you're a Centurion customer, you can buy a payment bracelet from them. They give it for free. But again, it's not free, right? Because you must be earning, you must be a Centurion customer, which means you're spending at least 150K with them per year. Excuse me. And 150K is you're getting fees of at least 3,000-4,000 per year on you. That's good enough for them to just give you a free ring. So that's fintechs, right? Fintechs are much more, let's call them lighter form banks. They are not banks. They're not regulated to hold your money. They're not regulated to borrow against your money, which a bank can. And they're also not regulated to hold or, pass on information around. They are well regulated to do a few minor things in terms of customer service, customer information. And we have some fintechs, which I'll get into as well, which coincidentally can only hold information and can't hold cash. They can process transactions. They can get cash from here. So for us, before we even go to a bank, we have a fintech that we work with. With all they do is they just take payment and pass it on. That's a fintech. You might not even know about them. I don't hear about them, but they're there. So let's talk about those different, let's call them players, okay, when it comes to your card. So you have a card and you got it and it's, maybe free from your bank, or you paid for it. And the question now is, so who are the people involved here, right? And so firstly, you have the issuer, right? So generally, generally you have a card. The issuer is always up here. So the issuer is the name of the bank. In this case, it's N26 in Germany. Sure, you can see that. So it's N26 in Germany. They are the issuer of the card. So when they say, who's the card issuer, you know straight away it's your bank, the bank, fintech. Someone issues this card and gives it to you is the card provider or the issuer of that device. And then below that, you always have, we call them the card networks. So these are the nets. So the bank would never issue a card. The banks give you a card, but they always issue it against something. So I have the contrast here, right? I'm just going to hide the number. So these are two different banks. You have your bank here, which is UBS Switzerland here, N26 in Germany here. And then you have the card network, which in this case would be Visa, always going to say Visa or MasterCard. And guess who's the strongest here? It's Visa, MasterCard. They're the strongest because it's their network. It's like you have a phone. Okay, you bought the phone, okay, iPhone, but it's useless without the carrier. It's useless without the network. So the network is the most important part. So that's one thing to learn as well. So whenever you see a card, it has to be Visa. They're more strong. It has to be Visa on Visa network, or it has to be on MasterCard network, or there are others now. It could also be Amex. It could be JCB. If you're in Asia, it could also be Europay. If you're in Europe, there's also, I think there are a few charge cards as well. There's Union Pay, and there's quite a few as well. But the major ones, the major connections is usually MasterCard or Visa. That's key. So they issue the card. They're the card issuers, but the bank then gives you the card. But in truth, the strongest people who decides percentage, who decides where it goes, who effectively routes the payments, they're the network providers. It's Visa, MasterCard. They're not banks. You have the banks who are the issuers, or the fintechs are the issuers. And then you have a second set of people, which you call the network. So the network is Visa, MasterCard, and try and put this down. It's easy to know this thing because now you open up your card, and at the bottom of With the card, you always see the network, which in this case is MasterCard. It could also be Visa, it could be JCB, it could be Union Pay. The network is always there, but the bank is always there. It's good to understand. But for us, it's not there because now we've got a strip which runs in the middle here. However, if you go to the app, on our app, MoneySave, you would see what it is. In this case, it's MasterCard. But we are also working with Visa as well in some countries. So you'll see if it's Visa or MasterCard. But it's always one of those two. We went with MasterCard, and there's no difference, by the way, as far as we're concerned, because the bank is where your fees come or go. So if MasterCard charge anything, Visa charge anything, they would usually pass it to your bank, and your bank charges you. So it's not free. When the payment goes through, it comes, and I'll explain that either in this video or the next video. But here's the point. So if you go to Visa, okay, and then you go your MasterCard, and then you tap it to make payment, the same thing with your any other card provider you have. So that I've explained, hopefully, the issuer, which is your bank, MasterCard, Visa, Union Pay, who are the network. Then there's someone on the other side, your merchant, like whoever you're paying to. Because you go to a card, you go to the machine and go, hey, I want to buy coffee. You go to the coffee machine. You have your bank, who's end-to-end. You've got MasterCard, who are the network providers, and you've got the Starbucks guy, or whoever is selling the coffee. They also have their bank, which most likely will be another bank. So it's getting more confusing than it's not. It's a trade. So you come in, you're going with your bank goes to MasterCard. MasterCard goes to the owner of the coffee shop. The owner of the coffee shop has their bank, which they pass the information on to, and then it then gets added to their account. So if you've got $5 that you want to spend on your coffee, you go to your bank goes, okay, that's $5. He has the money, he's good for it. They send it to MasterCard. MasterCard picks up the money, sends it on to the merchant. The merchant doesn't have, they just have a machine. So what they do is that they need to go to somewhere, which I will explain, with personal information to the merchant bank. Those set of people is what I would call payment aggregators. They are simply aggregated because they aggregate payments. Some people call them payment processors, information service providers, payment gateways. They're just aggregating. So all they do is they just take the money that's coming from Starbucks, and take the money that's going here, put that money together and decide where things go and settle it. They have, I think in truth, they have the ability if things go wrong, they do a lot of reconciliation. Sometimes this reconciliation takes a month to do. Back office guys do all that. But as far as it's concerned, you just tap to make a payment and it settles instantly. It settles, messages pass on, and on the back end, that's where you see things like chargebacks, you see things like recalls and things like that. And they allow up to 120 days on that. That's how long it takes to process these things. That's the truth. You might not know this, right? Because you just tap and the second you get it. That's because the personal information, it goes within this aggregate service, right? And the aggregators then go ahead and decide what goes where, who goes where within an instant, and then is reconciled afterwards. So what the payment processes, I think obviously we've talked about is the aggregators. So that will be Stripe. So Stripe are one of the top guys as well. It's expensive. Guys, do something about your fees. And then we also have people like Aidin give machines as well. So if you go to a POS machine, those POS guys, any name they are the aggregators. So they go in, they take the cash, and Aidin would then go in and go, hey, this cash is coming from John Luke. Okay, let's check he has enough money in his account. Okay, boom, we'll send the money to you. You get the money and then pass it to your card. That's it. All that happens in the split of like 1 or 2 seconds max. So when you go and you tap your ring or your card on the device, 1, 2, that's what you usually wait. You don't have to touch it, by the way. I'll talk about contactless in a minute. But as long as you're close enough to it and the sensors are within 4 millimeters, once you hit the 4 millimeter mark, it works and then you're done. So that's key. So again, I just want to summarize this, right? So you have learned at least 4 key categories. And I'll talk about fees separately. Who takes more, what fees, talk about interchange fees and changes and fees like that. But for now, I'm just going to keep this video simple, short on, let's call it players within a payment system. Well, I think I might have missed one, which is this. And let's talk about this box here, right? So this box is a chip and pin. So you put it in towards the chip and pin, facing upwards. And what it does, it's a card. It reads exactly your PIN information. You pass that information on. This doesn't need to be charged, right? You pass on the information, it reads what you have, in terms of information, sends the information back to the bank, sees if you have enough money, asks for a code, which would be your PIN code. They put that in, and they have access to the information. And that's why you have to be careful at ATM machine, because once you give that PIN code out and they can read this easily, that's gone. And then at the back of the card, I'm going to try and hide some information here. At the back of the card, you would have this wireless device. This wireless device is the contactless. So when you want to tap, you're not tapping this box, you're tapping the wireless. It's an indication of where the wireless device is. And in this case, if you're going to an ATM machine, tap where the wireless device is and they withdraw money from your account. Similar to this as well. So for our rings, the wireless device is not here or here or here, it's here. So what we do is when you wear your ring, that's why we say tap to pay. So you tap this way and it passes the information on and you make your payment immediately. So it's cool because guess what? Instead of carrying around this bulky wallet, so I have one of the coolest wallet, I think. It holds 12 cards, which is crazy. But then if you think about carrying all this around, you might as well carry your life with you, right? So what I do is I just carry this and I tap all my accounts are linked in here. I top it up weekly. It's my company, obviously. I top it up weekly and then I'm able to make payments irrespective of where I am in the world. And that's still the same thing because it goes into the same card provider. And if you prefer Visa, I think we're still working to talk to Visa or Amex. When we talk to those banks, those guys take forever to go through. And then, but MasterCard, I think MasterCard, we started that and within 1 year, we're able to be onboarded. That's how long it takes in terms of the design. Because I tell you, this is one of the toughest things to put together. Thank you.